Hello, Andrea.
Hi, how are you?
I'm good, how are you? Thank you for joining us. We're going to make a start as people continue to join.
So people in the previous session?
Yeah, so Mark has just finished. I made sure we wrapped up just before your session. Yeah, we could.
No, I was in there. I heard him.
Oh, you were there. Okay, great. Yeah, so Mark was on the previous session. People probably going to flip-flop straight from there over to this session. So we'll give people a little bit of time.
And where are people based?
All over. So the reason we've scheduled this session this afternoon is so that both the EMEA audience and the US audience can join. And then tomorrow, the session will be broadcast in APAC for that audience. So we're just replicating this event in APAC tomorrow as well. But obviously we won't have the live element in terms of Q&A.
Should I share my screen now?
Yeah, that'd be great. Thank you.
There we go.
Lovely. Great. So the audience is still joining, but I think we should probably get going because we're 2 minutes past the hour. So I'm pleased to introduce Andrea to the audience. Andrea is the Global Head of ESG for Moody's ESG Solutions Group. We'll be putting your questions to Andrea at the end of the session. So if you have anything that you want to ask throughout, please pop that in the Q&A box at the bottom. I'm going to mute myself for now, but I'll come back on at the end, Andrea, and let you know what questions have been put in the Q&A box.
Okay, thanks, Fiona, and welcome everybody. I was delighted to find out that ESG was going to be on the agenda. And before we jump into this session, which is talking about managing ESG risk in your supply chain, I thought it was worth just briefly stepping back to remind ourselves that ESG risk or any extra financial risk in the management of our business is really about improving our strategic resilience. And in short, that's the ability to anticipate, adapt, and position for future success without facing a financial or other crisis in the process. And when we distill that to the focus on ESG considerations in the supply chain, we can look at that specifically, but there's so much more to ESG risk that corporates face, but supply chains are pretty tricky. And so that's the topic of today's discussion. There are benefits. There are different short-term benefits and long-term value creation benefits to managing ESG risks in your supply chain. From a short-term benefit perspective, you'll build deeper, more holistic understanding of your suppliers. You get enhanced credibility, trust, and confidence with stakeholders, whether that's your customers, whether that's your suppliers, whether that's your investors. And you also have the ability to respond quickly to emerging regulation. And we're going to talk a little bit more about that shortly. And then there's the ability to identify and mitigate legal and financial risks early so that they're not constantly, buffering your business around and putting you on a reactive footing, which is never terribly comfortable. From a long-term value creation perspective, there are loads of good examples. And later in this discussion, I'm going to share some case studies, both where people are reacting to crises, but people have also done very effective long-term forward planning and what the differences are in how it has impacted their business. So from a long-term value creation perspective, of course, you're maintaining business continuity and you are being deliberate about where you're going and how you're going there. You're building strong relationships with suppliers, you're reducing disruption, and interestingly, you're promoting innovation, because if they understand what your priorities are, then you can work together with your suppliers toward the strategic objectives that you're setting for the firm and the key ESG performance and targets that you're setting for yourself, so that together you can constructively adapt over time to where you want to be. And then ultimately, you're improving your strategic resilience and your ability to adapt and position for the future, which is where we started. So what are some of the challenges in managing supply chains? The first point is that it can be a really tricky business. And some of the main pain points is that supply chains are frequently complex and globally dispersed. And the ESG interdependencies exist throughout. There are also a lot of hidden risks. So there's limited disclosure, I think, by all corporations, and I know that's due to improve, but for now, you really have to go out and look for what you want to know. And then you have to really understand what your supply chain standards are and your suppliers' details, and it can make it difficult to perform due diligence and monitor. So a lot of companies have really great policies, and they have good intentions from a monitoring point of view. Sometimes in remote regions, they'll have companies self-monitoring and reporting on what they're doing, and that can often come up and present some unwelcome surprises because it's not always what you were expecting. And there are a lot of activists who are out there really getting the information that they want everybody to know about. And so it's better off that you know than they know. And so you really have to look very closely. There's a lot of emerging regulation, and this increases demand for disclosure and reporting, which is going to help. But there's often regional nuances, and there's requirements that may be local to your jurisdiction, but there may be other requirements that are local to your supplier's jurisdiction, and then there depends on how much extraterritoriality there is and to what standards you need to manage for in the region where you're selling, because it's often consumer demand and consumer reaction or investor reaction to what you're doing that causes the problem. And then, of course, brings us to increased investor and consumer scrutiny. There's misalignment with investor and consumer values, and this can lead to reputational and financial risks. So I said I'd talk a little bit about some of the voluntary and mandatory regulatory reporting that's required. And here I've just got an example. The blue connotes things that are voluntary, the red connotes things that are mandatory, and they're very different regulations in different jurisdictions. And if you have a global supply chain, you have to manage to all of them, and then you have to manage to your own. And you need to be really clear on what are the standards you need to meet and how you need to report and communicate on those. And equally, from a monitoring perspective, it can be very complex because there's so many different standards and they're evolving all the time. So a good example is NFDR, which is a non-financial reporting directive that requires an immediate reaction because people need to get ready for that. So I said I would be taking you through some case studies, and Boohoo is a really good example. Many of you may recall Boohoo, which is a fast fashion retailer, hitting the news in July of 2020 around supplier practices in Leicester in the UK, where a manufacturing site was forcing their workers to come in during lockdown. They weren't honoring social distancing requirements, and they were paying their staff, I think, £3.50 an hour, which was below the UK national living wage. This hit the news. It also drew the attention of politicians. So the UK Home Secretary and consumers were aware of this. Other retailers stopped selling Boohoo's products pending investigation, and ESG funds started selling their shares and reevaluating their ESG assessment of investments. Okay, from an audit perspective, PwC resigned as their auditor in October of this year due to governance issues, and Boohoo was forced to launch an independent audit of its supply chain and allocate $10 million to upgrade its governance. And it's expected to face increasing scrutiny going forward. So now that the issue has arisen, people are always going to be looking very closely at what Boohoo is doing. And then the stock market impact, 2 weeks after the markets found out about the misdemeanor, the share price was down 30%. Co-founders needed to step in and buy back shares in order to support the share price. And generally, it's been a struggle. And I looked again now, and from a share price perspective, they're still down, but it's not, it's come back about 50%. What I'm showing you on the right here is we had an assessment out on Boohoo at the time, and a 26 out of 100 is very weak. And the issues and controversies that were arising were COVID, modern slavery controversies, and governance controversies. So it, for Boohoo, it was already sort of predicted that they were going to run into challenges and issues. And it was coming from an examination of their stated policies and practices. And ultimately it forced them to react, but not before they'd incurred the reputational and the value damage. And Boohoo was on a rise, and online retailers have been very successful throughout the pandemic because they weren't dealing in the bricks and mortar. So otherwise they would have been really well positioned to continue their growth had this not arisen. The next case study is, sorry, I'm not handling my mouse very well. The next case study is the Thailand floods of 2011. This has been a really well documented, well examined crisis from in 2011, when Thailand suffered its worst flooding in 50 years. And it especially impacted the industrial areas near Bangkok and disrupted global electronic, automotive, and food supply chains. There was over $44 billion in damages from the floods, both locally and globally. There was concentration risk. So the technology hardware sector was particularly hit with Thailand, where 25% of the world's manufacturing capacity was impacted by this flood. And then the stock market impacts were felt by November 30th, 2011, Thailand's stock exchange index was down by 17% from its July 29th high. And it hit its low for that period a few weeks after on October 4th with a drop of 28%. And what I'm showing you here on the right is climate risk reports that look at the area that was impacted by the floods. And you can see first of all, you can see the scores and the risk levels for certain companies. So there's KCE Electronics, there's Livono Group, which has a lower flood score of 13, Samsung Electronics 16. And then down here, you can see the financial impact on each of these companies. So the companies that had really high climate related and flood risk, like KCE Electronics, have the biggest impact on their ability to keep operating after the floods. And Samsung and Lenovo were better placed to, and mind the pun, weather the storm. And so it's worthwhile to make sure that you're checking your suppliers, you're checking the region they're operating in, you're checking their environmental, their social, and their governance related risks. And there's a lot of information out there that helps you get to this very quickly. So I promised you at the beginning, I would run through case studies where the impact of something happening results in financial or other crises that a company has to react to. I now want to run through two case studies that demonstrate how companies who prepare and manage very carefully can actually be very successful in managing ESG risk and developing strategic resilience over the long term. So I want to start with Unilever. In June of 2020, Unilever, from an ESG risk scoring perspective, scores 64 out of 100, and they rank second of 49 companies in the sector that we evaluate, and they are second only to Danone. Okay. Unilever has been awarded the top corporate leadership ranking in the 2020 Sustainability Leaders Survey for the 10th year running. So they're recognized for their performance and sustainability. And this is really credited to Paul Pullman, who retired as CEO in January 29, and he was a real champion of sustainability. And he believed that companies should put the common good before annual profit and focused on long-term strategy. He also believed, and I think this is really interesting, that sustainability is perfectly compatible with commercial success and that a business can grow while having its environmental impact. So he's not impractical. He's not saying, oh, exit businesses that have an environmental impact. What he was advocating for was proactive, deliberate management of the impact that you're having and setting yourself targets and measures that allow you to manage it effectively. So what Paul Pullman did was he introduced Unilever's Sustainable Living Plan, which creates awareness for the company's ecological and social challenges, and it built a roadmap to tackle it. And he communicated these ecological and social challenges throughout the company, so all of the employees knew and understood what Unilever was doing from an ESG performance perspective, and also knew that Unilever was tackling it. So that also contributes to your employee brand. They organized around 5 key areas, and those were climate action, gender equality, human health and nutrition of billions of people, respect for the environment, and a fairer, more prosperous world. And they set targets, they had reporting, and the use of materiality assessments in order to really focus in on the different areas of Unilever's supply chain that were going to be relevant for Unilever's ESG performance and their suppliers' performance. And then they strengthened their supplier relationships, and they created an opportunity for the advancing of global human rights through closer management of their value chain. And it also enabled them to build trust and address risks vital for the long-term success of their business. So I think the message from this one is they had a lot that they needed to do and a lot that they needed to address, and there was cost associated with that, but there was also benefit. And they realized that they needed to work in partnership with their suppliers in order to make that a success. And they were very effective in doing it, and they've gotten a lot of recognition as a result, and their share price over the 10-year period has continued to grow successfully. The final case study is a company called Interface, and it's one of Fortune's most admired US companies. In 1973, Ray Anderson was asked a question. He was asked, what is your company doing for the environment? And in 1973, he realized that he didn't know the answer to that. Now, this is a carpet manufacturing company. They are known for having created the carpet squares that we all used to see in our offices when we went into them. Okay. And in 1994, Mr. Anderson wanted to shift from traditional petroleum intensive operating model of take, make, and waste to a sustainable and ultimately restorative business model. He did this by setting 4 target areas for his company and for his suppliers in order to innovate into his next generation products. One of the categories was zero waste to landfill, zero fossil fuel energy use, zero processed water use, and zero greenhouse gas emissions. And by setting these objectives, he managed to achieve the following. He reduced waste by 85%. And since 1996, Interface have reduced manufacturing waste sent to landfill by 84%, and 49% of raw materials are either recycled or are bio-based. Savings on avoided waste are 450 million. So pretty substantial results there. They've achieved a 41% reduction in greenhouse gas emissions. Total energy use has been reduced by 39% per unit, and 36% of consumer energy is renewable. 7 out of 9 facilities operate with 100% renewable energy, and greenhouse gas emissions, as I said, were reduced by 41%. And then sustainability driving innovation. This has given Interface the edge over its competitors through innovation. First to publish a corporate sustainability report, and they have received certifications for their performance. And as I said, they're one of Fortune's most admired US companies. So they're a pretty heavy industrial company, providing an example of how proactively managing your supply chain to strategic objectives you set for yourself that really weave into the overall strategy of the company can build resilience over time. And then finally, just to conclude, you can only manage what you measure, and it's really hard to manage what you don't measure. So from a risk management perspective, it's really important to do materiality assessments so you know where to focus for your industry. It's not the same for every company. You need to perform your due diligence. You need to understand where you are and where your suppliers are. You need to actively monitor against targets that you set for yourself. And it's always really good to benchmark yourself against what other companies are doing so you understand what realistic targets look like. And then regularly report. And that should be from suppliers to the company, from the company to the senior leadership, and through the board. Innovation, long-term value creation, you've got to really embed sustainability policies into the broader policies of the organization. You have to partner with your suppliers, and it needs to be relational rather than transactional. So you need to sit down and say to them, here's what we're trying to do, and we want you to be able to do it because we want to continue working with you for the long term, and here's where we're going. And then finally, strategic investments and competitive positioning. So think about where you're going and do sustainability as part of an overall investment program rather than coming in after the fact and going, oh, what were the KPIs that we wanted to measure? It's better to have them up front, and you saw that in the Unilever example. And then from a strategic resilience point of view, it'll deliver strength and governance, it'll position the firm for the long term, and then it'll enhance your stakeholder support. And so I think that the case is pretty strong, and it's an important thing that you get going on early. I'm sure all of you do compliance and know your supplier work already, but it's typically focused on financial performance. And I think if you look at this as a journey and you embark upon it now with clear objectives in mind, you will improve over time and you will not get any nasty surprises. So with that, Fiona, I will take questions if there are any.
Great, thank you, Andrea. A couple of questions have come in the background. And actually, it's interesting that you mentioned the Unilever case study in relation to the first question. That's quite interesting. Someone's asked, do you see frequent instances of cost control being prioritized over the management of ESG risk, or do you think that companies are generally better educated in the importance of ESG risk management?
It's a really good question. I don't know that ESG performance improvement for strategic objectives is necessarily more expensive. There will be a period of transition and a period of adaptation, and you see that particularly in climate transition management. You can't expect to do it all at once, but you have to plan for it and you have to invest in it over time. And if you manage towards an operating model that offers more efficiencies or is more cost effective, it can equally deliver ESG performance. And that's sort of the ultimate. But you're investing in what you're doing over time anyway. I just think it was very unusual for people to be thinking about the sustainability targets and performance measures and incorporating that into what you were doing. So it doesn't always need to make it more expensive.
And another question here, you talked about how important it is to measure. What do you think the most important KPIs are that you can measure if ESG is an immature function in your organization?
I mean, most companies, frankly, start with E. Environmental seems to be the most obvious first one to get to. The social ones are a little bit more difficult. I think that depends on your sector and the materiality assessment for your sector. And if you haven't had a materiality assessment done for your own company, which is usually done through your corporate social responsibility area, you can always access research on ESG performance by sector, and you can quickly get a sense of what are the key issues facing this sector. And I can tell you, you should know what they are, because certainly the investor community knows what they are. And your customers know what they are, and your suppliers know what they are. So if you don't know what they are, you should. And so my recommendation would be, for the things that are material for your sector, focus in on those big ones first. Environmental seems to be the one that people go to, particularly in North America first. And in Europe, I think they've been at it for a little bit longer. And so social is playing a bigger role. And depending on the jurisdiction you're in, that can actually be mandated by regulation.
Great, thank you very much. We haven't got any open questions from the audience. I've got those two from the back end of the system, but nothing from the audience now. So if that's everything, we'll wrap up the session there, just heading towards past, which is perfect. So thank you, Andrea. We really appreciate your time. And the slides will be available after the event. We'll be able to share them with everyone, and the session will be available for people to watch on demand if they'd like to watch it again or share with colleagues. But thanks again, Andrea. We really appreciate it.
Thanks so much.
Take care. Bye.
Bye.